So at this point in time, we have already gotten in the door, gotten to our office, and that office is the kitchen table. And we've already started to build some rapport, just basic things that you guys will know how to do. And then at some point in time, we're going to need to pull up the computer, and we're going to pull this up, and this is the first slide that they actually see. And it's just to announce Equis Financial. And it's just very quickly, you just hit that and say we are Equis Financial. We work very hard in the local communities to protect what matters most. And it's actually not your mortgage, it is your family. And I'm usually nodding because I want them to acknowledge that, and they do. The mortgage is just the vehicle that's used to do this. So I'm not saying dedicated team of local professionals. They're reading that, but I'm just saying we work really hard in the local community here to protect what matters most. And it's actually not your mortgage, it is your family. I'm sure we would all agree that the mortgage is just the vehicle that's used to do that. And they acknowledge yes. Now, we're not captive, and I always have to define that. I want to define that. Don't ask them what it means. Nobody wants to feel small. So I just say, and all that means is there isn't just one company that takes care of covering everybody. And that's when I initially switched, because I want them to see all of the carriers. And I always mention these two first because they're very, very name recognition. Everybody knows Mutual of Omaha. So folks, we have Mutual of Omaha, Gerber, Foresters, Transamerica, American Amicable, and they'll say all the big ones. If they didn't know it was big, they do now. Remember, they're looking to you for as their professional. So I've got these things listed. I don't cover them. I'm not here for that. I want to keep their focus on mortgage protection. This is for you guys. This is for me to remember to make sure I cover these things. So on this particular slide, again, I'm saying, so when I'm here, I'll say, folks, just so you know, we're not captive, and all that means is that there is not just one company that takes care of protecting your family. There's about 14 different companies out there. Mutual of Omaha, Gerber, Foresters, Transamerica, American Amicable, all the big ones. And basically, what's nice about this is that having so many, because it doesn't matter whether you're 22 and have no medications and no health problems, or you're 81 and maybe you've had a heart attack or a stroke and you're a diabetic with insulin. Don't you agree that everybody should have the right to be protected? And they say yes, perfect. And so folks, that's the reason that's the reason for the in-person visit. All of these carriers have kind of agreed with the state of Ohio that as long as a state licensed underwriter comes out and just visually makes sure that everybody's alive, upright, breathing, not on oxygen, maybe, of course, there's a home on the property, they laugh, that there's no medical exam. Nobody's going to come out and make you urinate in a cup or draw your blood. It keeps it simplified issue, which expedites the underwriting process. Does that kind of make sense? And they go, yes. So now they know, and I'll say, because when an application gets sent up to a carrier, as long as we've told the truth on this sheet with medications, our medical histories, whether we had an operation on our hip 17 years ago, and it matches our MIB, they approve. And it's always the because it's quick. And so and by the way, if you know, that's the first time I mentioned when we take an application and send it to the carrier. Okay, that's one. We're going to say it like 3 more times. Because at the end of this 25-minute process, we want to do what? Take an application. That's the goal. So that's why I'm going to get it ingrained in their head that we're doing this today. And so then I'll go to the next slide. In fact, actually, let's go back. So one more time. So folks, we're not captive, and all that means is there's not just one company that does this. There's about 14 different companies out there that do this. Mutual of Omaha, Gerber, Foresters, Transamerica, American Amicable, all the big ones. And basically just means is whether you're 22 and you have no medications and no medical problems, or 81 and you've had cancer, you've had a stroke. Wouldn't we all agree that we all need to be protected? Yes. Okay. And so basically that keeps everything simplified issue, which just means that all of these carriers have agreed, the state of Ohio, that as long as somebody comes out from you can say it how you want to, as long as somebody comes out who's licensed and does uses the, let me back up, as long as the state licensed underwriter comes out and visually just makes sure that everybody's alive, upright, breathing, not on oxygen, there's a home on the property, that they will not do medical exams. It's called simplified issue. And that just expedites the underwriting process, and nobody's going to make you draw blood or your hand become. Okay, perfect. So, with that being said, what can you expect from me? Well, first of all, I'm going to really work hard to get you approved. That's my job. Number two, the carriers actually make this process really, really simple and really affordable with the simplified issue piece, because there's only two facets to this entire process. Wow. There's eligibility, which is what we qualify for, and that's not financial. We just did that. And remember, these people just refinanced or they bought a home. So I always make sure that I reference this. I'll say, now folks, there's eligibility, which is what we qualify for. It's not financial, Travis. We just did that. It's all medical. And suitability, which is what we're going to decide on today, and how we want to pay for it and how much we want to pay. Again, I'm assuming we're doing this today. I want to make sure that it's always ingrained. And so my job as an underwriter is to comprise a profile based on the underwriting questions here. So again, they're seeing this. This is already out and about with the lead. Comprise the profile, make a professional recommendation on what, here's the part where, folks, I promise you that I will not overcover you, but I surely will not undercover you either. My job is to make sure that with all of these carriers that we find the one that's going to give you the best coverage for the least out of pocket. Does that make sense? Yes. I always say yes. Perfect. So, folks, I know this isn't your first rodeo with mortgage protection. I'm not here to insult your intelligence, but there are a few things that have kind of changed for the better that I want to make sure that you understand and agree with here. So, wouldn't you agree that the first two bullet points are why you sent it in? And I want them to read that. So obviously, if something happens to with the one of you, we want the mortgage to be paid. But we want to eliminate any burden on a surviving spouse, sibling, any child. Does that make sense? And this is where I usually say, hey, have you ever known anybody where something's happened like that, whether it be family, a friend, a church member, and where it's and usually they all have a story to tell about somebody at church who had to have a car wash, or the church had to pitch in, or yeah, my grandmother, or yeah, my brother, or my dad's, whatever it is. And if they want to tell the story, let them tell the story. Because what do you think that's doing? Building rapport. It's evoking emotion. It's already emotional because it's their family. Now, if they're 25 years old or 30 years old, no disrespect here, but that's not something that's on your mind. I can tell you from personal experience, at 25 years old, I wasn't thinking about passing away. But I'm a little older now, and especially when you get older, it's a big deal. But generally, everybody knows somebody, so that's, again, why that's there. Let them tell their story. Now, here's a good spot, or here's a good spot. I'm going to let you choose how you want to do it. There's not something, but it has to be said, and I'll get to that in just a second. So it protects both the loan, equity, and bridges any gaps. We'll talk about that in a minute. But I'm not.
It's a touch screen.
Sorry. Good, thank you. Now, you choose the beneficiary. It does have a level death benefit, level premium. Folks, choosing the beneficiary for me personally, I think that's one of the most important parts of the entire process, of the entire mortgage protection world. In the old days, banks make themselves beneficiaries of these products, and at first your thought is, that's perfect, that's why I'm getting it, I just let them go to the bank. Well, here's why, from a husband and a father's point of view, again, now I'm humanizing myself. I've already built some rapport, but I'm coming back to me, and I'm going to humanize myself. This right here, sometimes would you agree that when you ask questions to a person, we already talked about this a few minutes ago, they want to know, remember we want the wall down very far, but when you start asking them questions, their wall will sometimes kind of go up. So I like to put the focus on me, and I want them to insert themselves into my situation. And then it'll kind of resonate, and then we're connecting, okay? So here's what I say. And I'm going to walk back through this one more time. So folks, I'm sure this isn't your first rodeo with mortgage protection, so I'm not going to insult your intelligence, but there are a few things that have kind of changed for the better that I want to make sure that you understand. Would we agree that the top two reasons here, top two bullets are kind of why we sent it in? And they'll say, oh, yeah, because we want to make sure we eliminate any burden on the family member, surviving spouse, and sibling, children, etc. It does protect the loan, the equity, bridges any gaps, and we'll talk about that in a minute. You choose the beneficiary. That is probably one of the most important things for me in my family. I'm a husband, I'm a father, you already know I have 5 children, so I want them to know about that. So here's the thing. Tell you what, the best way to explain this, Mr. Jones, is I'll tell you why I have mortgage protection, and then what I'd like you and your wife to do is kind of just insert yourself into my situation and see if anything correlates or resonates with you. And I'll say, so here's the thing, and I always use my hands, it's very visual. Remember, 15% of what you say is going to be retained. I don't know what that 15% is, so I have to use visual aids to make sure that they're getting it. So I'll say, so Bob and Mary, I make an income, my wife makes an income. But if for some reason, I didn't make it home tonight after my 7:30 appointment and I was killed in a car accident, are we all in agreement that tomorrow morning my wife would wake up husbandless, but every single one of our financial obligations would now be on her shoulders? And they say yes. I'm like, that's not a good thing, is it? I say no. Okay. So I have life insurance, but that's for mortgage protection. I mean, that's for income replacement. Now the reason I do that is because I'm not even quite sure yet if they even have life insurance. Statistically, they probably have 25, 50, maybe even 100,000. It doesn't matter what their number is. Sometimes people will justify in their minds, well, I have 100 grand. So if I died, then she just used that to pay off the mortgage. And if he was thinking for any level of 1 minute or more that he was going to use that when I showed him a price, I need to show him how he can't use that 100,000 for mortgage protection because his family would be financially devastated if they did. So I use me and I'll say, I have life insurance too, but that's for mortgage protection. Now why that's visual to do this, because I'm pushing it off the table because we're not using that. You're not going to give me that reason because it's not really justified. So again, I'll say, I have mortgage protection. I have life insurance, but that's for income replacement. And she would need every bit of that to last her as long as she possibly could. And I mean, think about it from this point of view. And most people don't have $250, so I always use that number. Let's just say that I have $250,000 of life insurance. Let's say I'm making $40,000, $50,000 a year. That's 5 years. I have a 14-year-old. He's got to go to college. The furnace might go out. I got a car payment. Do you see? And if we all think for 1 minute that my wife would take that $250 of a tax-free check, stick it into the bank, and just draw $4,000 a month on that, we know that's not true. And they'll go, oh, no way, because what do you think she'd do with that? And then they'll say, oh, you'd probably pay off your car or any credit cards. I'm like, yeah, which is what she should do, right? Well, yeah. Okay, but so it's going to be like a little bit less than that. So, and I've instructed her, that's exactly what you should do with that. But see, without mortgage protection, she can't just walk down to the bank, Bob, and ask the loan officer to lower her payment, right? They'll say, no. I'm like, why? And they know because they just did this. They'll say, oh, because she wouldn't qualify. Correct. Remember, we're talking about me, but they're right in it. And so I'll say, you're absolutely correct. So that's why I have mortgage protection, because I don't want her to have to worry about that. So one of 3 things can happen. She can either A, walk down, pay it off, which is wonderful. Now she still has my life insurance. Or she can go down and say, you know what, Joe? I know I couldn't qualify today because my DTI would be too high, but what would you need from me where I could pay it down to where I would qualify on my part-time income? And let's just say, since I used to be a loan officer, I'd say, you know what, probably 40,000. Okay, well here's your 60, because my mortgage is 110, and that leaves her how much? About 50,000, coupled with the life insurance, to make sure David can, and I'm going to spend the money. David's protected for college. She might need it just for life in general. Want to pay off any unsecured debt. So you're spending the money, but she still has the life insurance. So now, or she might say, you know what, now I can make payments on the home until I want to sell it. Because what if I had $100,000 of equity? Do you guys see how mortgage protection is, it absolutely is protecting my loan, it's protecting my equity, and it's bridging any gap that I would have in need. So I really am making sure that there are no burdens on my family. Do you kind of see you guys as stuff that you kind of like in the same situation? They go, oh, absolutely. Okay, perfect. See, well, we're all kind of in that same boat. So it does cover death due to illness or accident, which just basically means if somebody gets sick, get cancer, heart attack, stroke, and they pass away, it pays. If they fall off their porch, if they get in a car accident, if they, it's going to pay. Now, obviously, we know it doesn't cover suicide. That's always contestable. But it doesn't matter. It takes care of it. It can provide mortgage payment protection. We just talked about that. And we've already talked about the unsecured debt. So is this kind of what you thought it was? Most people didn't know what it was. That's why they sent in the form. But now they can agree with you because they're like, oh, yeah, no, that's exactly what we thought it was. Okay, perfect. Well, let's talk about you for a second and make sure that we get, and now we move to the underwriting sheet. Now this is, some people call it, I use it as an underwriting sheet. It's what I call it for them. Really, this is our financial inventory. Now we need the top part to make sure that we understand their name, age, height, weight, tobacco use, what they do for a living, if they're retired, if they work, any other, what kinds of income they have coming in, from a salary, from an investment. Some people will say, well, if you're retired, they're going to say, oh, well, I have Social Security. Great. And I always ask them, when I get to the income, I always say, Bob, Mary, now I need your income on a monthly basis separately. And the reason they need it separately, in fact, I'll get that to Ms. Sosa, he'll say, okay, no, I have $1,650 Social Security. Great. What else you have? Well, I have $450 from GM that I get every month. Okay, and that's from your retirement? Yes. Now, you guys are in this business, so I'm going to ask questions like, in fact, you may give me a few that may be better. I'll say, great. And how long do you receive that? Is that forever? Or is that just for like 10 years? Oh, no, it's forever. Okay, great. Now I don't ask the question yet because you already know what the question I want to ask, and that is, if you were to pass, does it go on to her? I'm not ready for that yet. Okay, perfect. So $1,650 plus $450. Okay, what else? And sometimes they say, well, that's really it. Now, what he really just said was there was, but he didn't want to tell me what the risk was. And I'm cool with that. I'm not ready for that yet. No problem. Okay. And ma'am, how about yourself? Oh, mine's $1,200. Okay, Social Security? All right. And what else? I don't have anything else. Okay, perfect. Well, thank you very much for that. And our mortgage amount right here is about, say, $95,000. All right. And your term, is it a 30-year term? 25, 20? Oh, it's a 30. Okay, great. 30-year term. And what is your payment every month to the bank with taxes and insurance? Okay, so that's $787. All right, wonderful. And just out of curiosity, do you guys pay any extra on the mortgage? A lot of people like to try to pay that down. And why am I asking that? We talked about this last time.
The 2 payments per month.
That's right, we're finding premium. And we're definitely finding premium. So let's just say they say, well, we pay an extra $50 a month. Okay, perfect. That's about average. 50 to 100 is what we see all the time. 50, okay, perfect. $50. That's wonderful. Good for you guys. So you're just trying to pay it off a little bit earlier. Yes, we are. All right, and talk to me about how about? Okay, I'm sorry. So we stop right there. So so name, age, height, weight, tobacco use, occupation, income separately, existing mortgage amount, mortgage payment and term. And that's about where I stop right there, because now I need to find out about him. This is going to help you understand what company I'm going to use and what kind of a product he's going to fit into, because it is a medical underwriting process. So I'll say, okay, great with Joe. Now when an application gets sent up to a carrier, which we're going to do to see if we get you qualified, second time we've talked about that, the first thing they're going to see is they're going to run our MIBs, which is kind of like our medical credit. You're going to find a lot of people don't know what that is. It's going to show like my current prescriptions, if I had my hip surgery 3 years ago, that kind of stuff. What are they going to see on you? What do you currently take right now today? And he's going to list whatever he can off the top of his head. Now, just so you know, you need to see the bottles. That's one of the reasons we do it in the home. If you bring one here to the office, you need to tell them to bring their prescriptions or a list that's typed out or written down, because you can't, here's what you're going to get a lot of. Well, I take a blood pressure pill. And great, what's the name of that? I don't know. Or, oh, it's lisinopril. I think it's 15 milligrams. Okay, well, I kind of need to, why don't you go grab your bottles, Joe? In fact, grab them all. Man, why don't you go get yours too? Because if it's 15, but it's really 40, then the underwriter might say, okay, did you just get increased? Because we see it as 40. So it has to be right. So you're going to gather their information. So we have a place here for medications. Why are you using it? Because we know that different medications can be used for different things. So even if you know lisinopril is for blood pressure, don't assume. Say, oh, I take a blood pressure pill. Oh, great. What's the name of that one? Oh, it's lisinopril. And you take that for what? Blood pressure. Okay, perfect. So you don't take it for any other reason? No. Okay, and the milligrams on that, let me check that out real quick. Okay, that's 10 milligrams 1 time a day. Perfect, that's what I write right there. All right, what else you got? 2, 3, 4, 5, whatever it is. And then you always need to dig a little deeper. And probably 50% of the time, this is what you're going to find when you ask this question. So you don't take anything else? Nope, I sure don't. Okay, perfect. Now, I need to jog your memory just a little bit, because sometimes it happens. Is there anything, Bob, in the medicine cabinet that you just don't take anymore because it just doesn't work for you? Oh, actually, yeah. Like that, we'll go cholesterol medicine. I don't even need that anymore. Okay, but it's on his MIB. So we need to know that. Okay, great. And why don't you go grab that one real quick? And he'll go grab it. It could be a cholesterol pill. It's usually pain medication. That's like the typical one. Now, I don't care. In fact, here's what I need to find out. Is it something that you think is still prescribed to you? Well, yeah, he gave it to me a couple years ago because he's, my arthritis is kind of getting. But I'm fine now. I've been exercising. But it's still on the MIB. Now, that's good information for you as an underwriter, because now you're going to write on here, and then you're going to transfer it to the application. Remember, you're the eyes and ears. You're a field underwriter. So you're the eyes and ears for Mutual of Omaha, for any of the carriers you're getting ready to submit to. And I can tell you from actually talking to these underwriters, they really appreciate when you write things like, Bob used to take oxycodone, whatever the pain medication is. Doctor prescribed it to him for arthritis, to help him with some pain, but actually he does not take it anymore. They appreciate that. It may or may not be prescribed, but you wrote it down, you dug a little deeper, and I will tell you that they have told me it's one of the reasons you see your approvals quicker, and more of them is because I'm trying to protect both the company and myself and really the client. I want to put them in the right product. So anytime we need to be more detailed we can be, the better. So we get all that good stuff there, perfect. So then, and for me personally, because I do have somebody else scrubbing my applications, I'll write just the conditions down. So if it was blood pressure, diabetes, cholesterol, whatever, just make sure it's kind of a double check. I do from the bottle get the doctor's information. Every single application asks for the doctor's name, address, and phone number, every one of them. So if I could just get Dr. Joe Montana, and what city is he in, ma'am? Oh, he's in Massillon. Okay, perfect. I'll just write Dr. Joe Montana, Massillon. I can Google it later. I just want to get at least Dr. Joe Montana and Massillon. That's all I need is a city. And also, too, last visit. And when was the last time you went for like a regular checkup? Oh, that was October of last year, or sometime in the fall. Try to jog their memory. It doesn't have to be exact. Remember, company's going to see it on the MIB. You just want to get close. I'll say, I think it was like September, October. Was it before Halloween? After? Usually oh, it was before Halloween. Yeah, it was in September. Okay, perfect. Thank you. September 2015. And the outcome was it just like a regular checkup? It was a regular checkup. Okay, perfect. outcome normal. And that's what they need to have. So we've gathered their personal information about them, height, weight, stuff, Joe's medications, we know his conditions, when he went to the doctor. Okay, Bob, okay, Mary, you're up. Now Mary gives you hers, right here. Now, all this stuff is really important because we've gone through the presentation, you understand the importance of it. Now you're going to determine what product you're going to put them in. They sent in a lead form and a notice that said, I have a $90,000 mortgage, I want mortgage protection. Now this is where you're going to decide, do they qualify for a term product? Or because he had a heart attack 3 years ago, or 6 years ago, or a stroke, or he's a diabetic with insulin, most carriers will not do a term life product if you are a diabetic with insulin. You don't need to remember that, but I'm just telling you from an underwriting guideline, most of the companies, they will not. And the reason that's important is because now if he doesn't qualify, if he does, it's real easy. A couple different prices, a couple different carriers, boom, you pick the product and term that he likes, it's over. But if he doesn't qualify, then either A, we're going to have to go to a whole life product for a full like $100,000, which a lot of them are the minimum of the $100,000, or we're going to have to do what we call payment protection, a payment protection plan of 25, 30. A couple companies will go up to 50. Sometimes clients have it in their minds, if I can't protect the mortgage, meaning all 90,000 of it, well then it's just not worth it. Well, we know that's not true. Because here's what we still don't know. We still don't know what's going to happen, what he has in place. So we're getting ready to ask that question. So I will say, so if this sheet were up there, and I have it here, it's got his income written in here, so now just picture you're sitting at the table, sitting in front of you, and I've got my pen in hand. And now here's what I say. So this is all completed, we've got the meds, we're ready. Now I need to evoke some emotion. I need to enter their world. They entered mine for a little bit, now I'm going to enter theirs. Now this is where people, this uncomfortable question that you're getting ready to ask them is where you actually, in my opinion, is where you actually convince them, not sell them, you convince them that they need it and they need it today. So I'll say, we'll just use Bob and Mary. So Bob, Mary, obviously we got this form, you sent it in. I need to ask you a question as if I've known you for 25 years. It's really important because it's going to determine whether we're going to be protecting loan, equity, and bridging gaps. I want to make sure that I do right by you. Do you remember when I said I'm not going to overprotect you, but I'm sure that I'm going to underprotect you? Correct. This is going to help me do that. So this is where I need you to kind of level with me. So Bob, I'm going to ask you first. Bob, if you would have died yesterday, now please don't feel. You might feel initially like you need to say pass away because you feel like it's a little bit more, it's softer. Okay. Now, do you think for any reason at all that it's a soft thing if somebody dies? If my wife died, it would not be soft. If my husband died, it wouldn't be soft. If my child died, okay? So the point is you have to use the word because you have to evoke the emotion. So, Bob, if you would have died yesterday, and I let it set for a second, because usually what you feel and hear in the room, the thickness, comes right from where she's sitting. She didn't like that. And that was on purpose, because and she's listening to him now because I'm having a conversation with him. So once again, so Bob, if you would have died yesterday, before I came here today to take care of this, what do you have on your life today that even begins to act like mortgage protection? Now you're going to get one of two things. Either A, and this happens a lot, well, what do you mean? Do that 1 minute. So what if he says, well, I have life insurance, which is really what you're after. And if they say, well, what do you mean? Well, I'm talking about like a life insurance. I mean, you just passed. Your wife needs to offset this mortgage like today. So what do you have? Well, I've got life insurance. Okay, perfect. Like I said earlier, I do too. But that's going to be for income replacement. I'm talking about something for the mortgage. Okay, do you see what I did there? I went back to what I originally did, which was kind of a setup for this, because it's absolutely true. Remember, we have an income, and I think I remember what I said, 1650 Social Security and 1200. Please enlighten me for the people on the tape. What happens just if you have Bob on 1650 and Mary at 1200, what happens when one of them passes?
One check.
That's what, one check. And so they usually get which one?
The higher of the two.
The higher of the two. So if Bob passes away and that 1200 goes away from Mary, now her new income is 1650. Now, we don't know yet about the pension because I'm getting ready to ask that question, but let's just say for hypothetical sake, it's not there. She's got her husband just died, she has a $90,000 mortgage, she has $50,000 of life insurance, and she has an income now of like $27,000 a year. And all of the bills. What I don't know, because I didn't get into it, I could have, and need to, and should have. Do you have any credit card bills? Do you help your granddaughter Susie with her college every month? Do you pay her gas bill? Is Joe on your credit for his car? Did you go sign for his car payment? Because you'll see that a lot. Because they'll make statements like, I can't afford to do this because we actually pay for our sons. If those things happen, it's okay. But remember, she's got 1650. So that's why you asked the question that you did. It's why I took the 50,000 and threw it off the table. I'm actually trying to protect that 50,000 because Mary is going to need every bit of that. So I'm creating the need, answering their question for them that, yes, sir, you did do right by sending this form in. You do need this mortgage protection. Great job. So when I say, Bob, what if you would have died yesterday before I showed up here today to take care of your family? What do you have on your life today that even begins to act like mortgage protection? Well, what do you mean? Well, I'm talking about my life insurance. Oh yeah, well I've got 50,000. Okay, perfect. That's great. And just like I said earlier, I do too. But that's for income replacement. Bob, I'm talking about something to offset the mortgage. Well, that's what I have. Okay, perfect. And then I was congratulated because 10 years ago he thought he did a really good thing, and he did. But today he's 10 years older and has a $90,000 mortgage. So he needs more. So I'll say, no, that's great. And you know what, sir? Most people don't really even have that. So Mary, you need to make sure your husband did a good thing for you. That's great. But now we need to make sure that this mortgage gets paid. And then I paint the picture one more time. Mary, if you were to, here's why I asked that, because see, and this is where I literally, Mary, because because what's going to happen is, I'm sure you know this, and if you don't, if Bob really did pass away, your 1200, you don't have that anymore. That 1650 becomes your new income. Did you know that? And it's about a 50-50. Well, I think so, but I don't like to think about that. I get that a lot. Or no, actually I didn't. Is that true, Bob? Yeah, honey, it is. So if she's hearing this for the first time, this is a big deal. Okay, perfect. Yeah, that's 1650. Now here's that question for you, Bob. Wow, that's wonderful. $450 a pension. Not even a lot of people have that. Now, is that something that you get for life, or is that something like if you passed away? And he'll say, I'll say, hold on, let me ask you a question. When you originally left GM, a lot of companies will actually offer you the option of, you can take this amount, and then when you pass, that's it. Or you can take a lesser portion. Oh, no, yeah, that's what I did. Or no, I didn't. So you're going to find out right there. And you're actually hoping that it's the second one, because she's going to need the income. But even with that, let's just say if the $400 continues. So now she's at $2,000 a month. We all know inflation doubles every what? About 22 years. So now in about 10, 12 years, that 2,000 is not worth 2,000 anymore, is it? So we're helping to protect her. So let's just say it wasn't. Okay, no, actually, when I pass away, it goes away. Okay, so that 1650 is truly your new income. Yes. Okay. Now I see. Now I see why you sent in the form. That's always my call. Now, it makes sense. Good job. And I always give a little thumbs up because,
Make them feel good about
yeah, make it good. It's for me personally, it doesn't matter what amount of protection they do, whether they do a payment protection plan for $20,000 or whether we cover the whole mortgage. We're doing something. He needs it. We just found out and told him. He told me he needed it, and now he's realizing it. We're doing this. Next question. This helps you decide, and let's just, now I'm going to go both. So now, if he is totally qualified for term, then I want, for the camera, I want to make sure they know that you move on, you quote the price, you get it, you see that something is great. And we'll talk about that in just a second. That's wonderful. But this is what you're going to find a lot. Let's say it's in that 55 to 70-year-old range. Here's what's going to happen. Probably 4 out of 10. I'm going to say sometimes 5 out of 10. Where we're going to have an issue. We're going to have some insulin, some diabetes. We're going to have a heart attack. We're going to have, well, I didn't have a heart attack, but I went to the hospital 4 years ago for chest pains. Underwriters don't like to see that. That's like a huge red flag. So you may have to do what I'm calling a payment protection plan. I don't care if the guy's got $50,000 or $350,000 of life insurance. It doesn't matter. If you kick it to the curb, that's for income replacement. Okay. And by the way, let me go back here because this is an objection that sometimes does come up. It doesn't matter whether it's 50 or 250. Take your calculator and let's say that she says, well, I have $200,000 life insurance. Okay, perfect. And then you can take that, so you know, and that's wonderful. Let's say you spent $50,000 paying off any unsecured debt. So now you have $150,000 left. You divide that by 1,200. You can divide it by well, actually you divide by 1,200 plus the 450. So now we're talking 1,700. So that'd be 88 payments. You're right, that'd be 7.5 years worth of income. So what that's telling you is that if for the next 7 years after Bob would pass away, your lifestyle could remain the same. So you'd be 60 years old, you're 53 now, and then it would switch. It's not a good picture, but it's okay for you have to be able to paint that sometimes. Because she thinks she's fine. She's not fine. Now, we're going to do something different with that too, obviously. So I know we would, but the point is in her mind that she's going to draw it. She's going to draw it and it's over. Remember, we're here for mortgage protection. We can talk about annuities and later, but this is what we're here for. Her mind, don't confuse her. So that's why. So this is good. Objections are going to come up. So we've got the scenario where he said, no problem, we write him $90,000, he gets paid. And he takes it, we take the app. But a lot of times you're going to have that scenario where you need to do something a little smaller. So how you do that is, now Mary, I have a question for you. If Bob really did pass away yesterday, and you got this $90,000 mortgage, beautiful home, are you staying in the house? And here's what you get a lot. Why I haven't thought about it. Well, I need you to think about it for just a minute, and I'm not going to hold you to it. And by the way, you're going to paint both pictures, but you might want to hear, because Bob needs to hear this too. It doesn't matter what she says, but Bob needs to hear it. Well, you know, I haven't thought about it. Well, I guess the reason I asked that question is because if your income really was only $1,650, and we've got quite a bit of yard out here, we've got a nice piece of property, do you usually like mow the yard, take care of projects and different things, Bob, or does Mary get involved in that? Most of the time, oh no, I don't touch that. You know what, I am not getting on that mower. I couldn't do that. My bat couldn't take it. It doesn't matter what she says. Most of the time she's not. Oh, okay. And sometimes you hear this. Oh my gosh, no, I'm moving to Texas. If he passed away, I'm moving to Texas with my sister. That's it. Okay, but either way, you needed to know as an agent. Because here's the thing. He's got $50,000 for the mortgage or for income replacement. But if she's moving, now you can easily move into a payment protection plan. Whew. And that heart attack, because I'd have played heck getting him qualified for $90,000. I'm so glad Mary's moving. Because now you can do a $25,000, $30,000 and still protect the family. Because we want to protect the loan, protect the equity, or protect the gap. So here's what I do. I'll say, great, okay, so you're moving. All right, well, here's why I say that. Do you guys remember when I said we're either going to protect the loan, the equity, or bridge any gaps? Okay, so it's still going to be protected, but here's kind of what I'm focusing on right now, is that equity. Because here's the thing, Bob. would you agree right now you have a $90,000 mortgage, but you did a conventional loan, so it's at least 20%. So would you say your home's worth probably 120, maybe 130,000? And he says, yes. Now you are selling, by the way. And he's like, I understand. It's okay, it's perfect. So right now, today, we probably have about $30,000 of equity. But let's just say, I mean, you're pretty healthy for the most part, but let's just say 15 years from now you passed. And that's where I do open my computer and I do use the amortization calculator. And I'll say, I'll put in his loan amount, 90,000, 4%, 30-year mortgage, and I put in that extra $50 he's paying. So this is real-time numbers. And I go down to payment 180, and it says you'd owe $43,000. So in 15 years, Bob, you'd owe $43,000. If you died, that's what she owes. But would you also agree that, say, $2,000 to $3,000 a year, your home is now worth 15 years later, let's just call it $150. So you owe 43, but it's worth 150. So this mortgage protection plan, remember, no price yet, but I'm building value. When value exceeds price, people buy. Period. Yeah. When value exceeds price, people buy. Okay, so would you guys both agree that whatever we decide on today to protect the mortgage for, we are not protecting First Federal, because that's who the loan's with, because it would be taken care of. We're protecting $107,000 of equity that belongs to your family. And they go, oh, absolutely. Okay, perfect. So I make sure we're on the same page. Okay, so no matter what the price is, whether it's $50, 107, we're protecting $100 grand. And then I always paint the picture, not if you do, but what if you don't? Because if we didn't put this in place today, and you really did pass away 15 years from now, and you really did owe $43,000, and all you had was 50, and you couldn't make the payments on a consistent basis with keeping the lights on for any period of time to sell the house, Bob, what would happen to the home? Would the bank take it back? Right. And who would get the $107,000? Well, First Federal. You're right. Okay. So again, people do things in life for two different reasons: to avoid pain and to gain pleasure. That's painful. He doesn't like that. So we're doing it. That's the second time. So that's what we do here. So perfect. Okay. So here and then now you're going to price, and this is your choice. I'm just to say, company A can give her 50 or 35,000 is about the average normal that's about the top of the game for a final expense whole life product. So let's just do 30,000, 25, and 20. It's going to be a difference of probably $15 to $20 a month per deal. It's their choice, and so so let's just say we did 30,000, 25,000, and 20. Now I like giving choices because the customer needs to make the decision. It doesn't matter which one they choose, because here's in my mind, here's what I've done. I've taken the mortgage payment, and I think we made it up at $775, which is probably about right, times 12, that's $9,300. That's what they spend every year in mortgage payments. Let's just call that she literally did go to Texas, but the house needed to have the lights still on and electricity on, so let's just call it another $300 a month. Plus, that's $12,900. But because in the loan business, you understand there's closing costs, there's an appraisal. In 15 years, we might have some roof damage. We might have some damage to the door jamb. I don't want Mary to have to pull anything out of that 50 grand. So I'm going to add in another $5,000 for anything that might need to be done with the house. I'm protecting her. That's $17,900. So do you see why $20,000 would be like the bare minimum? But it could be 25 or 30. Okay. So I'll write 30, 25, and 20. And then I'll put the price of whatever would run for that, for a monthly premium. So now when I turn this around, I'm going to say, now here's the thing. This is where you guys come in. You and I need to make sure this fits the budget. But we got to protect that $100,000 of equity. Because, Mary, you said you'd probably move to Texas with your sister, or you probably wouldn't stay here, then do you understand why you necessarily wouldn't need $90,000 of mortgage protection? Now remember, why did I say that? I can't get him qualified for a term product. I have no choice. He doesn't need to know that. unless it came up. So here's the thing, but I want to be beneficial for you. So, Bob, I mean, I could try to get you qualified for $90,000, but sir, first of all, you don't need it. It'd be a lot of money. It'd probably be $400 or $500 a month, even if I could. But because of what Mary said, sir, that would only benefit me and the insurance company for you to do that. So we just need a payment protection plan. And here's what we're going to do. I put 3 different face amounts down here because I want you to know that no matter which one you chose, it would work for you. Because if you really did pass away yesterday, your wife's going to need, and that's where I do exactly what I just do with you. I'm like, first of all, your payment's $775. That's $9,300. That's what you spent today. And she would have to continue to spend that. And then she would need to, and I'd walk her through that. So that's about $17,000. And then you're going to need some other things. So if she's truly going to move, now what you've done for her is that now she can make the payment comfortably, continue to live, try not to touch a lot of that income she has coming in now, because it changed, not for the better. And then, when it does so, whether it's 80, 107, we don't know that number yet, whatever it is, coupled with her 150, she still gets her $2,000 a month from you, your benefit at GM. And now no matter what she does, she can go pay cash for a cottage right here in Summit County and not have a payment at all. She can move to Texas with her sister and bank it and play with the grandkids and take care of Susie's tuition if she needs to, and all those things that grandmas love to do. Or she might say, you know what? I've got 20,000, I've got 25,000, I've got 30,000. Wonder what the payment would be. Oh my gosh, if I put 20 and I only owe 43, my payment on 23,000, is that right? Would it only be $159 a month in a 30-year mortgage before taxes and insurance? So my payment would probably go $300 a month. I could afford that. This is about painting pictures of what if you do and what if you don't. It doesn't matter what they choose. It works for them. Because she could afford $300 a month on a $2,000 income. So whether she decides to stay or whether she decides to go, what you did back in 2016 for Bob and Mary worked. You protected them, you protected that life insurance, you protected their family. And the premium on $25,000, $30,000, I don't care if it's 53 or 65, is probably going to be in the neighborhood of $80 to about $130 a month. That's about where they're at. And because they're making around $3,500 a month right now, they can afford that. And they'll do it every day of the week. And they'll, by the way, I showed them 3 prices for this reason. For the no different than any car maker, there's always 3 models. There's for Honda, there's the SX, the LX, and the EX. That's why they do, because people purchase the second or third thing to show them. Always. It's in every sales book in the country. That's why I do it. And they usually pick the middle, and I'm fine with that. Because I protected their family, I kept my integrity, I did right by them, and then for that 401k I sifted to D. So, but the point is that that's what we did. So do you see, first of all, let's backtrack just to kind of make sure we understand. Equis Financial, we're not captive. Here are the carriers. We're keeping it simple with non-medical. We explain mortgage protection. This is where you have to insert yourself into my situation. Zach, you're not married, right?
No.
Okay. So now that you've heard my story, I've always tell all of my people that I work with, now that you've heard my story, you can do one of 2 things. Because you might say, well, I don't have a wife, I don't have children, I don't have that situation. I'm not going to feel comfortable talking about that. And wrong answer. Travis, the same thing. You're not married. Okay, so here's what you do. You can, one, go, actually, my manager talks about this all the time. Or I work with a guy at our company, here's what he says, and you use my situation. Or, obviously you guys know I'm a little young, but I do know my mom and dad's situation. My dad makes an income, my mom makes an income. Use that one. You're humanizing yourself. But they're in a situation, so it doesn't matter what it is, you can use it. Because now when you tell a story that's truthful, now I'm telling you, you can use my story, and you can do that. So we've done exactly here. We've eliminated any burdens. We protected all three. Chose the beneficiary. They understood this. Took care of this. Took care of this. Took care of that. So that's what. And again, it sounds like a lot, but remember, this is for them. In the beginning of our careers, I'm the first one to raise my hand. I really needed this. In fact, I was so glad that I had it. But after about 25, 30 presentations to clients, I didn't need it for me. I kind of memorized it. I could probably give it to you right now without looking at it. But remember, 15% of what we say is retained by anybody we talk to. So I want them to read this. I did some ad-libbing in here, but this right here will help people build value, and when value exceeds the price of regardless of what you show them, they will see the value, and you will take 8 to 10 out of every 8 to 10 applications every single time.